Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
All right, so it is 3 p.m. here in New York. We're going to get things started. So thanks everyone for joining us. Welcome to this afternoon's webinar. Today's session will be hosted by Ilian Yotov, who will be teaching us how to use the quarters theory with FX options. Ilian is an FX strategist and creator of the quarters theory. His published works include the quarters theory, the revolutionary new foreign currencies trading method. Ilian was one of the leading Forex educators in the world and has trained thousands of Forex traders from over 20 countries across the globe. He is also the founder of allthingsforex.com and tradertape.com and host of the popular broadcasts on All Things Forex. So, Ilian, we're going to go ahead and turn it over to you for today's presentation. Thanks.
Thank you so much, Katrina. I appreciate it, and thank you to our friends at ISC for putting this webinar together. Thank you for all of our attendees today. Welcome aboard. What we're going to discuss today is some of the methodologies of the quarters theory that I created and some of the synergies between the quarters theory and FX options, a great product created a few years back by the International Securities Exchange, and hopefully you'll be able to learn a lot of good, interesting things today. Thank you for that introduction as well, Katrina. Many of you are familiar with my name as the creator of the quarters theory. My book, The Quarters Theory, The Revolutionary New Foreign Currencies Trading Method, was published by John Wiley & Sons last year, and it is available everywhere where books are sold, whether on the internet or at your local Barnes & Noble or Borders bookstores. I also invite you to join me Monday through Friday for live daily analysis of current events on the foreign exchange markets, and listen to my daily All Things Forex broadcast on my website, www.allthingsforex.com. Let's go ahead and get started with some of the basics on what the premise of the quarters theory is built upon as far as the foundation of the quarters theory. The foundation of the quarters theory methodology is the base 10 numeral system of our world. Many of you know that the decimal system is a positional numeral system. It has positions for units, tens, hundreds, and so forth. The position of each digit conveys to the multiplier, which is a power of 10. To be used with that digit, each position has a value 10 times that of the position to the right. Now, in a decimal notation, we're writing numbers in a base 10 numeral system, which uses various symbols called digits for 10 distinct values to represent numbers, 0, 1, 2, and so forth, up to 9. Some of the real and whole numbers include the counting numbers, the integers, rational numbers, and irrational numbers. And what the quarters theory focuses mainly on is the whole numbers. I'd like you to take a very quick look here at the table of whole numbers. I want you to notice the first row, the first number in each row. When you take a look at that table of whole numbers, you will see that the first number in each row represents a critical junction that marks the end of one set of numbers, of 10 numbers, and then at the same time the beginning of a brand new set of numbers. Why is this important? Well, it is important because with the quarters theory, I focus on what I call the major whole numbers, the ones that start at the same time, start and end a previous set, and then end the previous set and then start a brand new set of 10 numbers. Those major whole numbers would be, for example, 10, 20, 30, 40, 50, 60, 100, 1,000, and so forth. Currency exchange rates are also represented with decimal whole numbers, where you have the decimal point. For example, euro-dollar exchange rate could be $1.30, 1.30, or 1.31, 1.32, 1.40, and so forth. With the Australian dollar against the US dollar exchange rate, we could have 0.80 or 0.81, 0.82, 0.90, and so forth. Now, the major decimal whole numbers would be, instead of 30, 40, 50, 60, with currency exchange rates, the major decimal whole numbers for the euro-dollar exchange rate, for example, would be 1.30 or $1.30, 1.40 or $1.40, and so forth. Aussie dollar would be 0.60 or 60 cents, 0.70, 0.80. Dollar Canadian, let's say it's at parity, which is 1 for 1, $1, 1.00, 1.10, 1.20, 1.30. And when we take a look at these major decimal whole numbers through which the currency exchange rates are represented, we know that through the process of currency decimalization, 1 unit of the main currency is divided into 100 subunits. For example, 1 euro or 1 US dollar are divided into 100 subunits called cents. 1 Swiss franc would be divided into 100 units called centimes, or 100 centimes. 1 British pound is divided into 100 pence. Now, for further precision, when currency exchange rates are represented, for further precision, they are decimalized even further by dividing the actual subunits, not just the main units, but also dividing the subunits. So the subunits were what? 1 cent, 1 centime, 1 pence. So 1 cent is divided further into 100 additional subunits, which are called price interest points, or as many of you know, pips, short for price interest points. Or in some currencies, like the Japanese yen, for example, the main unit is divided into 100 additional subunits. For example, 1 yen is divided also into 100 pips. So when we take a look in terms of pips, we're going to realize very quickly that when we look at the distance between 2 major whole numbers, we'll have a very clearly defined constant range of 1,000 pips, 10 cents or 10 centimes or 10 yen. In terms of pips or price interest points, that's 1,000 pips. And in between 2 regular whole numbers, we'll have also a very clearly defined range, which is smaller. It's going to be a 100 pip range, 1 penny, 1 centime, 1 yen. So the quarters theory focuses on these 1,000 pip ranges and 100 pip ranges. And here's an example that's on your screen that lets you see that, for example, if the euro-dollar exchange rate was into the $1.30s, the major whole number at the $1.30 would mark the beginning of the 1,000 pip range between $1.30 and $1.40. Those are the 2 major whole numbers that define that range. And then in between, you have regular whole numbers such as $1.31, 1.32, 1.33, 34, and so forth. And the distance between the major whole numbers, $1.30 and $1.40, or 1.30, 1.40, would be 10 cents or 1,000 pips. The distance between, let's say, 1.30 and 1.31 is 100 pips. So this is what gives you the 1,000 pip ranges between the major whole numbers and between regular whole numbers. Between each whole number within the 1,000 pip ranges, we have smaller ranges of 100 pips. So what are the actual quarters? Well, we know that a quarter is a part of something, and in a decimal numeral system, we actually can divide these ranges into 4 equal parts, or as I do, 4 quarters, whether large or small. When we divide, for example, the 1,000 pip range between $1.30 and $1.40, those are the major whole large quarter points, major whole numbers, we will get several large quarters, 4 equal parts or 4 large quarters of 250 pips each. This is what the 1,000 pip range looks like here between 1.30 and 1.40. And in between, we will have 4 large quarters between $1.30 and $1.3250, 1.3250 to 1.35, 1.35 to 1.3750, and then 1.3750 to 1.40. And when we divide with the quarters theory, I also divide the 100 pip ranges into 4 equal parts and derive 4 small quarters of 25 pips each. For example, if the 100 pip range between 1.30 and 1.31 is divided into 4 equal parts, we'll get 4 small quarters between 1.30 and 1.3025, 1.3025 to 1.3050, 1.3050 to 1.3025, and 1.3075 rather, I'm sorry, and 1.3075 to 1.31. The quarters theory focuses mainly on the large quarters, and I will give you some examples. But before that, let's do a little bit of a practice from what you have learned so far. And let's try to do a little exercise here and try to identify in several different examples what would be the 1,000 pip range, the large quarter that the currency exchange rate is trading within, what would be the 100 pip range, and then with an even more precision, we can zoom in, if you will, and take a closer look to even the small quarter where a currency exchange rate is currently trading within. Okay, I'm seeing one of our participants says that there's no sound. Are you able to hear me?
Yep, everything sounds fine over here. If anyone's experiencing any issues with sound, please check the webinar email that you received with your registration. That should have a call-in number for you to be able to call in and join us.
All right, great. Thank you so much. All right, so let's do a little exercise. And for example, take a look at, let's assume that the euro-dollar exchange rate is at 1.2345 or $1.23 and 45 pips. So what would be the 1,000 pip range that the currency exchange rate is within at that point? That would be the 1,000 pip range between 1.20 and 1.30, $1.20 and $1.30. Okay, let's zoom in a little bit closer and take a look and see what would be the large quarter that the currency exchange rate is within. If the current rate is 1.2345, that would be the large quarter between 1.2250 and 1.25 cents. So if we take a look at the 100 pip range at 1.2345, the 100 pip range would be between the whole numbers at 1.23 and 1.24. And then for even further precision, if we were to zoom in even closer, we will establish that the small quarter that the currency exchange rate is trading within is the quarter at 1.2345 current close. The small quarter would be between 1.2325 and 1.2350. Now this is a little exercise so that you can get a little bit more used to identifying the actual ranges, the actual large quarters, small quarters, and so forth. So let's do the same thing with the dollar-yen. Let's say the dollar-yen is at 96.78. That is your current quote right now. So applying the methodology of the quarters theory, a trader can say, okay, I can now know that the 1,000 pip range is between 90 and 100 yen at 96.78. That's your 1,000 pip range. What will be the large quarter? If the quote is 96.78, then the large quarter is 95 to 97.50 yen, 97.50 yen. And then the 100 pip range is between 96 and 97 yen, and small quarter would be 96.75 to 97. So you can do that exercise with currency exchange rate in the future so that you can get and practice as far as identifying the 1,000 pip ranges, the 100 pip ranges, the large quarters, and the small quarters. Now we're going to talk about the main premise of the quarters theory. So with the quarters theory, I create familiar, constant predictable ranges that never ever change. They are always constant ranges. These large quarters are always 250 pips each. The 1,000 pip ranges are always 1,000 pip ranges. They're always 1,000 pips. So how does that benefit a trader? Well, by creating a familiar, constant, never-changing environment, obviously one of the benefits is that support and resistance levels vary. They change on a daily basis or weekly basis and so forth. Pivot points have to be recalculated every single day in order to establish them. They're reliable price points of reference, and they definitely should be utilized in any trader's technical analysis methodologies. But with the quarters theory, what happens? Especially now that we've seen, let's say, the Australian dollar, for example, reaching brand new all-time highs, or at least highs that were not ever reached since the Australian government allowed their currency, the Australian dollar, to float freely in the open markets. What does a trader need to do? What points can be utilized? One would say, well, maybe they can calculate some pivot points. Based on what? If you're trading into price levels that have not been reached before, what could be a reliable price point of reference? And in these type of examples, the quarters theory price points are very helpful, reliable, constant price levels that can be utilized as reliable price points of reference. And I'll show you some examples later on in this webinar as far as the quarters theory coming to help. The premise of the quarters theory, besides creating constant, never-changing ranges, the main premise of the quarters theory is, so I basically, what the quarters theory proposed, that price fluctuations are not random, that prices do not move in a chaotic manner, but rather in an organized manner. And I propose that every significant price move takes place from one large quarter point targeting another large quarter point. So there is organization when it comes to the quarters theory methodology. Constant, never-changing, familiar price ranges. And with the quarters theory methodology, we establish the starting point of a price move, and we know clearly what the destination is. In other words, a price move always starts at a large quarter point and always ends at a large quarter point. Now, I'd like to show you the following examples of, these are the real-life examples, obviously, most recently with euro-dollar exchange rate. Now, let's take a look at this chart. It's a daily chart going all the way back to August, September of 2010. What can we establish here? Now that we're able to recognize these ranges, we can see that for the most part, which is almost a year now, it looks like most of the price activity for the euro-dollar exchange rate has been taking place within the 1,000 pip range, defined by the two major large quarter points at $1.30 and $1.40. With very few exceptions, where the euro is traded for a month or so here below $1.30 and for a few weeks above $1.40. And then in recent weeks, obviously, we've broken above $1.40 level, and I'll give you some examples of that later on. But for the most part, for the majority of the last, if not 1 year, at least for the majority of the last 9 months, we have seen the euro-dollar exchange rate trading clearly within the range between $1.30 and $1.40. So what would be the large quarter points within that large, within that 1,000 pip range between $1.40 and $1.30? That would be $1.30 to $1.3250, $1.3250 to $1.35, $1.35 to $1.3750, $1.3750 to $1.40. So with the quarters theory, I propose that every significant price move begins from a large quarter point and targets another large quarter point. Here's a picture-perfect textbook example of those type of price patterns. Now let's take a look. Excuse me 1 second. Where is that? That slide. Oh, you know what, Katrina, you know what? I think that I added it a little bit later. I had to send that presentation.
Oh, do we have an additional slide that's missing now?
Yeah, I do. That's what I was wondering. Where did that one go?
Oh, no.
That's okay. Can I exchange my desktop from here?
Yeah, sure. You should be able to.
Okay, 1 second. Bear with me, guys. I'm sorry about that. Yeah, I added it actually yesterday afternoon. And,
okay, yeah. If you go up to share, you should be able to share your desktop.
Okay, let's do that. Okay, let me go and do share and then desktop. Okay. Okay, are you guys able to see the desktop now?
Yep, looks like we've got it.
Okay, good, good. So this is the slide that I wanted to show. It's a very important slide because it shows you these price patterns that if you haven't been paying attention to them, then at least from now on, you'll be able to identify them, I think, for the rest of your trading careers. Let's take a look at the euro-dollar currency pair. That is ticker symbol EUU when it comes to ICFX options. In, what is that, March 17th or so, the trading session then, the euro-dollar exchange rate breaks above the major large quarter point at $1.40. So when we see that type of a price move, that breakout above a major large quarter point or a large quarter point occur, if a trader is utilizing the methodologies of the quarters theory, then obviously the next logical price point that we can anticipate to be targeted would be the large quarter point above $1.40. As we know, with the methodology of the quarters theory proposes that every significant price move takes place from one large quarter point targeting another large quarter point. So what we're seeing there is the breakout above $1.40. It's a bullish price move. The euro is moving higher, and then it goes up, and it reaches this price point right there. Those of you who pay attention to the euro-dollar exchange rate will remember that the high on these couple of days was $1.47.52, if I'm not mistaken. Hold on here. I think I had it somewhere. Okay, there we go. This is, I'll show you that in a minute. So we'll reach $1.47, $1.42.47. Then prices never break above the large quarter point of $1.42.50. According to the quarters theory, when prices remain below a targeted large quarter point, they can complete the quarter. But if they do not break above a targeted large quarter point, if there isn't a decisive breakout, then the most likely prices will start working on a large quarter below rather than above $1.42.50 large quarter point. So what happens next? For a couple of days here, we have two identical highs at $1.42.47 and $1.42.45 or so. And then the next day, prices start breaking down, and they go, guess where? To the large quarter point at $1.40. They reach this low here, which is $1.40.21. They never break below $1.40. They remain above the large quarter point. Then they reverse back to the large quarter point at $1.42.50. On this next attempt, however, prices do break above $1.42.50. And where would you say, applying the premises of the quarters theory, what do you think the next large quarter point targeted will be? Prices produce a decisive breakout above $1.42.50, and then the door would be wide open for them to work on the next large quarter between $1.42.50 and $1.45, which is a large quarter point above $42.50. And so in recent example, in recent days and weeks, we have seen those type of patterns taking place, which is pretty much of a textbook example as far as the quarters theory methodologies are concerned.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.